Hey guys! Welcome back to another video. Today, we will be talking about financial assets. Let's get started. Financial assets are essentially something you own that has value. Let's talk about 3 of them that you need to know. The first financial asset is stocks, which represents ownership, or equity, of a corporation. Investors often purchase shares of a corporation stock, expecting that the stock will increase in value in the future and bring back high returns. The next financial asset is bonds, which are loans to a corporation or government. Bonds are also known as interest-bearing assets because when an investor purchases a bond, they have loaned the corporation money and will be paid back with interest as the loan matures. Before we talk about the final financial asset you need to know, we must go over the important concept of liquidity. When describing financial assets, liquidity refers to how easily an asset can be converted into cash and be used for transactions or purchases. This brings us to the last financial asset you need to know. Money. Money includes cold hard cash, as well as checking and savings accounts. Money is also the most liquid asset. You can easily buy things with money without needing to convert anything. On the other hand, stocks and bonds are not as liquid as money. You can't buy things with a stock or bond. You must convert it to money first and then use that money to buy things. Now, let's dive a little deeper into bonds and how interest rates can affect bond prices. The price of previously issued bonds and interest rates are inversely related, meaning that when interest rates rise, bond prices fall, and when interest rates fall, bond prices rise. It may be confusing to understand why this happens, so we'll explain how it works. First, bonds have fixed interest payments. So, when interest rates rise, newer bonds offer better returns with higher interest rates, so previously issued bonds that pay lower interest are less attractive to buyers, which causes the price of existing bonds to drop. On the other hand, if interest rates fall, previously issued bonds with higher fixed interest rates become more attractive for buyers, which causes the price of existing bonds to increase. Let's use an example so it's easier to understand. Suppose you own a bond that pays $100 a year in interest. Interest rates rise and now newer bonds are being issued that pay higher interest, like $120 a year. People want bonds with higher interest payments, so the old bonds become less attractive, causing their prices to fall. Now let's say that interest rates fall and newer bonds are being issued that pay lower interest, like $80 a year. People want bonds with higher interest payments, so the old bonds become more attractive, causing their prices to rise. Coming back to the topic of financial assets as a whole, we need to talk about the opportunity cost of holding money rather than other assets. The opportunity cost of holding money is the interest that could have been earned from holding other financial assets such as bonds. Again, this might be confusing, so let us explain. Because money is the most liquid asset and easy to make purchases with, many people choose to hold some or all of their wealth as money, instead of holding other financial assets like bonds. Remember that bonds pay interest to its holders. So by holding money, you'll miss out on all the interest that you could have earned if you held bonds instead. That's it for this video. Thanks for watching and make sure to like and subscribe. See you in the next one.